You have 1 lakh to invest, but where should you put it? Large cap stocks, mid cap stocks, or small cap stocks? Many investors make one common mistake. They choose the category that has recently given the highest return. But investing is not about chasing yesterday's winner. In this video, I'll explain the difference between large cap, mid cap, and small cap stocks, their risks and potential returns, and finally, how I would think about investing 1 lakh. Let's start with large cap stocks. Large cap companies are generally the biggest and most established companies in the stock market. Think of businesses with strong brands, large revenues, established operations, and a long operating history. Examples in India include companies such as Reliance Industries, TCS, HDFC Bank, and Infosys. The biggest advantage of large cap stocks is relative stability. They can still fall significantly during a market crash, so don't confuse large cap with risk-free. But compared with smaller companies, large caps generally have more established businesses and better access to capital. The trade-off is that because these companies are already very large, their future growth rate may be more moderate. Now, let's move to mid-caps. Mid-cap companies sit between large established companies and smaller businesses. Many mid-cap companies are already successful, but they still have room to expand into new markets, increase revenues, and become much larger businesses. And that's what makes mid-caps interesting. They can potentially deliver higher growth than large caps, but there is a price for that opportunity: higher volatility. During a strong bull market, mid-caps can rise rapidly. But when sentiment changes, they can also fall sharply. So mid-caps can be attractive for investors who have a longer investment horizon and can tolerate temporary declines. Then we have small caps. Small cap companies are smaller in size and are often at an earlier stage of their growth journey. This is where things become really interesting and really risky. A successful small cap company can potentially grow many times over if its business expands dramatically. But the opposite is also possible. Some small companies struggle with debt, competition, weak cash flows, or poor management. And during market corrections, small cap stocks can experience very large declines. Therefore, small caps should not be selected simply because a stock looks cheap. Cheap does not always mean undervalued. A small cap requires much more research into the business, management, debt, cash flow, and valuation. So how do these 3 categories compare? Think about them like 3 different vehicles. Large cap is like a strong, reliable SUV. Mid cap is like a performance car with more speed and more movement. Small cap is like a high-performance sports bike. You can potentially go much faster, but the ride can be much more unpredictable. In simple terms, large caps generally offer lower volatility and relatively lower growth potential. Mid caps offer a balance between growth and risk. Small caps offer the highest growth potential, but also significantly higher volatility and business risk. And remember, these are general characteristics, not guarantees. Now comes the most important question. Where should your 1 lakh go? There is no single answer for everyone. Your age, income stability, financial goals, emergency fund, existing investments, and risk tolerance all matter. But if you are investing for the long term and want diversification, instead of putting the entire 1 lakh into one category, you could consider spreading the money. For example, a hypothetical allocation could be 50,000 rupees in large caps, 30,000 rupees in mid caps, and 20,000 rupees in small caps. This gives the portfolio a relatively stable core, while still providing exposure to higher growth segments. But this is only an example, not a personal investment recommendation. If you are more conservative, you may want a higher large cap allocation. If you have a long horizon and can tolerate substantial volatility, you may consider greater exposure to mid caps and small caps. But here's something even more important. Don't choose an investment category simply because it performed well last year. Markets move in cycles. The category that leads today may not lead tomorrow. And a high return comes with a price, usually higher risk or volatility. Instead of asking, which category will give me the highest return, ask, which level of risk can I stay invested through? Because the best investment is not necessarily the one with the highest possible return. It is the one you can hold through market corrections without making emotional decisions. So, large cap, mid cap, or small cap? The answer is not one category. Large caps can provide stability, mid caps can provide a balance of growth and risk, small caps can provide higher growth potential, but with much higher uncertainty. For a 1 lakh investment, diversification can be more sensible than betting everything on one segment. And before investing, always consider your time horizon, risk tolerance, and financial goals. One final rule: don't invest because someone on social media promised you a multi-bagger. Understand what you own, stay diversified, think long-term, and let compounding do the heavy lifting. If you found this video useful, subscribe to Naveen Finance for simple and practical lessons on investing, personal finance, and wealth creation.